this is Amy from iTradeAIMS.net and AIMS Stress-Free Trading. Okay, so I got a question about the wave analysis of the entire chart, and since I have been on holiday for the past 6 to 8 weeks and did not make any video, and I thought, why not take this opportunity and create a video. So we are going to look at the DAX 30, or the German 30 index, and we're going to look at it from the year 2000. And we are going to use not the Elliott wave per se, but the AIMS wave technique for this method. So if you look at this is here, that is the year 2000, and it was around 8,000, the value of it was. And this is something that is called the dot-com crash. So companies like Yahoo and stuff, and there was this biggest scam, I think the biggest fraud the companies could ever do, the Enron scam. It was, the whole company was a scam, and it was a big corporate company. Now they are enjoying their time in prison and stuff, but this is what happened around that time. And if you look at it, it dropped from 8,000 to 2,000. Now that is pretty bad. That is like 4 times down. So if for example, the Dow Jones, if the Dow Jones index was to tumble something like this, it's gonna go down to 7,000. Currently, the highest level was 29,000. Anyway, so after that, it recovered. Obviously, that is what happens, and this is one of the biggest lessons, that these things don't always just destroy the world. The bad companies and the good companies together, they all come down, they lose value, and then people find value in it again and they invest more money. And as you can see, this is where our AIM setup was. What we call the monarch was here. If you bought here, price went up and up, and this is the hunt signals. The hunt signals appear usually within a confirmed trend inside it where there's a pause. This would have been a beautiful hunt signal. I mean, we don't trade monthly charts, but just saying, if somebody was investing, your risk would be 500 points and you would have made 2,000 points, all the way there. So if you were following these, so if you look at it, if this was here, you could have easily predicted that market might respond to those levels, and it did respond to it in the form of what? In the form of the 2008 crash. So this is the 2008 crash. Now look at it again. DAX went to 8,000. and it dropped all the way down to 3,600, and that is where the current bull market started. And it did it in a very typical Elliott wave fashion. So you have the first wave one up, and as soon as it comes near these levels, which is the previous levels, let's extend them, it dropped. So this is what usually the Elliott wave psychology tells us, that when price goes up, when there's uncertainty and buyers kick in, the initial buyers, these long-term investors, started investing the money, price goes up. Around here, some of them, they get out and price immediately goes down. Now this is like a very strong drop within a month, like a huge 2,000 drop that happened. Something must have happened, and it was 2011. I am forgetting what it was. I did know what it was, but I don't remember right now. Anyway, I'll probably add it later when I remember. So remember this, wave C are usually very impulsive waves, and they are connected with news. Events like these, like the pandemic that is happening right now, and we are going towards it gradually, but I am building towards it. Okay, so this is wave one and this is two, and around here nobody would have believed that a 10 years bull market has started, but if you trade a system, if you trade a method that gives you an edge, which has been checked over the past whatever value of data was available, like this, our system, you would have taken this trade here, because this is a blue dot, purple is correct, and Gator, you have a P, cross of zero line, monarch. This is your signal to go long and just stay long after that. If not that, then you would have gone long here and taken a trade. So this is the pattern that repeats itself on any other time frame. Like you can go to the M1 chart on this very market and you would see this pattern happen every hour. So why wait 10 years if you can, you know, take advantage of this pattern in an hour? Anyway, so this is your wave 1, that's your 2, and then the wave 3 up continues. Now see this pattern here where the cherry signal is? This is what we call the PC pattern. The PC has a wave C in it as well. So inside there's an impulsive wave that has been rejected by these lows. So it tried to, can you see this sequence of the stepping up box? So when there's a price action that actually tries to break the lows of the stepping up, but does not actually continue going down, actually it's like a fake out. In this case it was definitely a fake out. This is a PC, which means this would form the wave 4 of the 3 up. So within this is actually 1, 2, 3, this becomes a 4, and that becomes your 5. And what is the simple trick that allows you to predict where wave 5 might end? It is the Fib expansion. You start with a start of 3, drag it here, and where is it? This is target zone 1. So around here, if you knew it's a PC, you could have predicted that this is where price would come. And in the grand scheme of things, let's go back. Wave 3s, if you could identify wave 1 and 2, then you can identify where most probably wave 3 would be, and that is going to be here, the Fib expansion 161.8. So if this was our previous large wave 1 and 2, this wave 1 and 2 is inside this sequence, so that's 1, 2, 3, 4, 5. So we can now put, normally I start from the start of wave 3 and drag this here. You can see that around this wave 3 and this wave 4, when you were going long here, you could have predicted that based on this, wave 3 end was there, as well as the wave 5 end of the wave 3 was there. So you had a coincidence come in, and then that was proven again. So you have 1, 2, 3, 4, 5, and then this is your wave A down, and that's your B up. So what is this? This is that B trap, what we call the B trap. It looks like the resumption of trend, but actually this is a fake. This is where buyers get trapped, and this is where a lot of buyers would have been trapped thinking, okay, let's buy the high of this because the trend might continue. But this was the B trap, because this is A, this is B, and what follows AB is the C wave. And like I said, remember, wave C's are always connected with news, and they're very impulsive. So if you look at this, this is a 5,000 points drop, and as we know, this is the global pandemic. Coronavirus sadly is doing all this because there's uncertainty, there's fear. Whenever there is fear in the market and uncertainty, people would get out of their positions, or they are not going to buy. So even the lack of buying would produce a lot of price decreases, and then add to it more sell orders. And if you have sell orders which are not met by buy orders, the prices will drop, and it keeps dropping. So that is the case. So you can say that around 2009, at this time here, when the market was actually dropping, the world was getting destroyed, people were talking about credit crunch and all that. This was actually the bottom of wave 2, where this mega trend has actually started. So you could, around this time, or if not there, then around this time, which was in around 2011, not in 2008, but 2011, around here, and if not there, around here in 2012, you could have predicted that the bull markets might go and take this index to 13,000 level. In the next video, I might do similar analysis on the Dow Jones, the US 30, and that's what it is. Before we go, let's quickly go to the daily chart And that is what is happening on the daily chart. It's just dropping down. See you later.
Thank you for watching. I hope you liked this video, and if yes, please hit the like button. Do you have any questions or ideas for upcoming videos? Then leave a comment. Also subscribe to the channel and hit the bell icon so that you never miss any future videos. See you next time.